Meg Energy is Eric's first idea.
So the investment thesis for Meg is incredibly simple. I'm getting 35 years. It's a single asset oil sand company. So I'm getting 35 years of reserves. The stock is now trading at a 32% free cash flow yield at $100 oil. Therefore, they could privatize themselves with 3 years of free cash flow. So I say, okay, 35 years minus 3, I'm getting 32 years of free cash flow for free. And every year they're going to free cash flow $1.4 billion. So I'm getting $40 billion of value for free. And so my pitch to the boards of these companies is, what's the value of your last share? You're a $18 share price now. The last guy standing gets $40 billion. Now, that assumes a static share price.
Sure,
Andy,
sure.
You're going to say, well, that's really dumb, because as you buy back the shares, it's going to go up. And that's my pitch to the boards. They have the ability to drive the re-rating in their share price from 18 to a heck of a lot higher number. Maybe not 40 billion, but decent upside.
It's a great way to put it, though.
Decent point regardless, or upside regardless. So I think fair value on this name is about a 12-13% free cash flow yield. They've committed to return 100% of that free cash flow back to investors by about this time next year. It's going to be 50% soon, going to 100. And so they've committed to me that I'm going to get paid all of that 32% in about a year's time, 50% now while they still pay down debt. And so that's as simple. If you're an oil bull, I cannot think of a better name than this name. We've put a 6 multiple on it. I get about a $42 share price. So I'm getting about 130% upside in that.
So they're SAG-D. They don't need to buy any more land.
No, certainly not.
Okay.
No.
So what is their capex then?
It's minimal. Well, let's get into it. So they're going to cash flow next year $1.84 billion. Capex is about $450 million. So you're generating $1.39 billion of free cash flow. About half of that is going to the balance sheet to pay down debt. Okay. The other half is going to be coming back to us in the form of buybacks. Once they achieve their final leverage metric, which is about Q3 of next year, we're going to get 100% of that.
Okay, we better keep moving here, Eric. I could listen to you all day. Always learn so much. Tamarack Valley is your next idea. So
Tamarack has been a massive acquirer. It's been an overhang on the stock. They've been aggregating land from a bunch of privates in the Clearwater play, which we've talked about, most economic play in North America, wells that pay out in weeks or months. Because you've had this overhang, stocks, I think, is only up 7 or 8% this year. We're up 54, so it has actually cost me performance, and I've got a fire under their behind to fix that for me. I'm paying 2.2 times cash flow, and they're trading at a 41% free cash flow yield next year. So these guys can privatize with 2.5 years. They did use debt, so they're paying that down. That did defer the meaningful returns. We think we'll be hitting 50% pretty soon. I've got to wait till I can't even buy the right calendar for us to get 100 unless they sell off some non-core assets, because we don't get 100% until 2024. If they were able to sell off some non-core assets, which the market very clearly is not giving them any credit for, they can bring forward their leverage target. Therefore, I can get paid 75%, 100% of that free cash flow quicker than most people expect. And so that's kind of what I'm counting on. It's a 10%er in my fund. Anytime I get a chance, I'm buying 1 million shares at any time that I can. And I'd be the second largest shareholder now. ARC Financial, courtesy of an acquisitions #1.
Okay. Baytex Energy, the final idea.
So same pitch. You've got meaningful upside to the Clearwater. I'm paying a discount to market multiple, 1.8 times. It's trading at a modestly attractive 40% free cash flow yield next year, so they can privatize with 2.5 years. They've committed to return the vast majority of that free cash flow back. I'll be getting about 75% of that when we're talking in 1 year from now, as they continue to delever. We think a 5 multiple is appropriate given the quality of the acreage. And new CEO, which I've spoken with, he seems like a very solid guy. I'm looking forward to the chance of meeting with him in person. We're the largest shareholder, so we've got a good say in terms of what they should be doing with the free cash flow, and I think they're on the same page as us. And so if I can buy a good name at a 40% free cash flow yield, trading sub 2 times, where I'm getting exposure to the most economic play in North America, to me, that's moderately attractive. So we put a 5 multiple on that. We get almost a $20 share price, which is a decent upside from current trading levels.
Again, that's Alberta non-fracked wells.
Correct, yeah.
What, just costs are low in Alberta?
Yeah, you're looking at about 1.3 to 1.4 million. And you've got
for a well.
For a well, so very, very cheap. You've got very high well productivity, and so you get the balance between production and revenue relative to cost means you're paying out the well in weeks to months. In the olden days, it used to be, well, geez, if you pay out in a year and a half, then that's reasonable. You can generate a decent rate of return. Now it's been such a game changer. But because there's only Canoe and I left in Canada to discern, to try to make it an inefficient market, which is incredibly inefficient, to make it more efficient, I can buy these names at a discount to what the average company is trading at, and I shouldn't be able to do that. And so I just think as these companies continue to generate egregious levels of free cash flow, and most importantly, commit to returning the vast majority of that back to us, that will act as a catalyst to drive a re-rating in these names. And so we're looking for a very, very solid finish to the year as the SPR ends. And more importantly, for 2023, we've had the greatest drop in inventories this year, with several headwinds which should be ending. And so I look to next year, we see continued inventory drawdowns despite a likely recession in certain pockets of the world. And so you can believe in a recession, still be bullish oil, and be wildly excited about the prospect for energy stocks next year.
Eric, thank you very much.